Tuesday, January 20th, 2026, Maneko 64, home of alternative economics and contrarian views. Yes, there's a lot going on about Greenland. It's a huge distraction. Davos, Trump is supposed to go there to negotiate with the Europeans. But there's something even more important going on that most people won't hear about today. And that's the meltdown in the Japanese government bond market. Yes, the second biggest government bond market in the world after US Treasuries. And we know that the Japanese government has over 200% of debt to GDP, but we've always been told that they owe it to themselves and that the Japanese are big savers and that nothing would happen. But I'm sorry that paradigm is being destroyed, and I think this is very serious, and it's starting in Japan. We're in a world where government bonds are not going to be safe havens anymore, and it's very serious. I've spoken about Exter's pyramid, inverted pyramid of liquidity. I think we could be in such an event, and when that happens, all the risky assets and bets, they're liquidated, and capital rushes down this liquidity pyramid. Towards the end, there's government bonds, long-term government bonds, medium-term, short-term, cash, and then at the end of the pyramid, at the tip of the inverted pyramid, is gold. And I think there will be silver as well. I'll add silver to it. And yes, it's going to be, gold and silver are going to be the only safe havens now. And even Ray Dalio talked about this. He posted something on X saying that the whole system is unwinding. He said it's an international breakdown, a financial breakdown. So I think it's very serious. We're going to look at what's happening this morning. I'm not being alarmist. Yeah, we're going to go over why government bonds have been so important in the last 40 years. And yeah, what they provide the market, what signals they provide. Well, government bonds are supposed to be they give you the risk-free rate of return. So every other asset from stocks to corporate bonds, other kinds of bonds, or anything that has an income, real estate, it's priced off that risk-free rate of return, be it in the US with the US Treasuries, be it in Japan with JGBs, be it in the UK with gilts. But now that these markets are collapsing, and especially in the longer end, these long-term government bonds, they're crashing in prices. And I'm not being exaggerating here, because I worked in government bond markets for 20 years. I was a futures and options broker in the government bond market. I advised institutional clients, pension funds, corporate treasuries. So I know what I'm talking about, and I follow those markets every day. And I can tell you what's happening today in Japan is unprecedented. Right now, as I speak, the 30-year JGB yield is up 30 basis points. That's like a third of a percent. And that's more akin to like the Turkish, let's say, government bond market. That's what happens in Turkey when they have a crisis, not in Japan. So this is very serious. We're at 391. The 40-year, that's up about 29 basis points, and it's above 4. And the 10-year is up about 10, and it's around 236. Up until recently, well, up until three and a half years ago, it was near zero, this 10-year yield. And what happens is that regulators have told pension funds, life insurance companies, banks, that they need to hold government bonds as assets to protect their operations. So these financial institutions, not just in Japan, but in the city of London, in the US, in Europe, they're all loaded up to here with government bonds, and now their values are crashing. And I've heard from my source that the Japanese financial sector is panicking, and they're buying gold. Yeah, life insurance companies, fund managers, pension funds, they're having to buy gold because the value of their portfolio is dropping massively. And there's something called duration risk. So if you're holding a 1-year Japanese government bond, the risk isn't that big because that loan is going to be paid in a year's time. So the price doesn't really fluctuate. But when you have a 20, 30, or 40 year, or even a 10 year, and you get this kind of risk and this kind of move in the markets, the value of it is going to drop massively. And all these government bond markets are linked to each other, the Western government bond markets, and you can bet it's going to spill over, and it's already spilling over into the US. We saw yesterday, despite the holiday yesterday, bond yields ticked up. This morning, the US 10-year yield is at almost 430. It's up another 5 basis points. The 30 years at 491, up another 7 basis points. And let's just quickly look at the UK. Well, the UK yield curve is still under control, but I think there's a lot of risk there. The 10 years at 446, up 4, and the 30 years up 5 basis points at 521. And there was a story that came out, let's see, I think it was during the weekend, on Sunday, and the Bank of England warned here. It says, Bank of England alarm as hedge fund gilt bets hit 100 billion. And it says sudden economic or financial shock, risks triggering fire sale in UK bonds, officials warn. That's the Bank of England warning, and they're the ones providing the liquidity through short-term repos. And how do I know that? Well, because the Bank of England publishes that every day, and the short-term repos, which are weekly repos, they're up to almost 100 billion. That's funding provided to these hedge funds that are betting, doing derivatives bet on gilts. That's keeping an artificially high demand for government bonds. So the fact that the Bank of England warned that some kind of financial shock could trigger fire sales, well, it could be this financial shock coming from Japan. And yes, that paradigm that government bonds will always be safe, well, that's going out the window. And why do I think that is so? Well, because the bull market in bonds that we had from the early 80s until 2020, that kept this illusion of safety in the government bond market, because interest rates and yields were always dropping. So governments and borrowers could always roll over and borrow for less. It also meant that they could borrow more, so they would buy more assets. Asset prices went up. But as I've said many times, there's something called cycles. Nothing is linear in nature. And now we're going the other way. We're going into a world where yields and interest rates will generally go higher. And that's going to have the inverse effect. And unfortunately, the financial sector in the West, they've always leveraged so much, just like the Bank of England is warning here. So they're of the opinion that we're still in that old paradigm where yields and interest rates always go down. And one could argue the Bank of England and the central banks could step in and do massive amounts of QE to buy these bonds and drive their yields lower. Well, but that would put an even bigger fire up the rocket ship of gold and silver. That would destroy the currency. So they're between a rock and a hard place. And I hope a lot of you have been able to protect your savings. I hope a lot of you don't have that much in the bank. I mean, I have fiat deposits, or I have fiat in the bank to operate my household and my business, of course, but I try to keep as little as possible. So, yeah, this is very serious. You can bet we're going to keep an eye on this. Aside from what's going on in Greenland, I think this is the most important thing. We could see the mother of all crises, and that is the sovereign bond market meltdown, sovereign bond debt crisis. Yeah, we had a precursor to that back in 2011, 2012, but those were peripheral countries in Europe. What we're seeing now are the biggest economies in the world, and that's Japan, the US, even the German government bonds. They're kind of under pressure as well. And I'm just trying to find here what Ray Dalio said. Oh yeah, here we go. I think that was a post Ray Dalio made yesterday, and it sounded like what I've been warning you about for over 10 years. It's now happening. The existing fiat monetary order, yes, he said that, the domestic political order and the international geopolitical order are all breaking down. So we are at the brink of wars. It is all happening because of the big cycle that is driven by the 5 big forces I've described repeatedly and laid out in detail in my book and the linked video titled Principles for Dealing with the Changing World Order. Do you understand the big cycle, and do you know how to deal with it? I'd like to help you. I will continue to share with you my understanding of how the mechanics work and how I see things transpiring. If you want me to send your postings, you can sign up below. So there you go. I think if you've been listening to me as well, you should be well prepared for what's coming. And what about mining investments in the system? Yes, you need to think about counterparty risk, but if you have enough physical gold and silver, I think that would be a good hedge. Am I selling my mining stocks here and cashing it in and buying physical gold? No. I think the last thing the powers that be will do is allow the system to completely implode and close down. So I think they're going to throw everything at it, and all that will mean is that will put more fuel in the rocket ship that gold and silver are going to become. Those are the new safe haven, gold and silver. So yeah, it's 8:15 a.m. We've got spot gold at a new all-time high here, right around 47.25. It's up 52 bucks. Silver is at 94.70, up about 38 cents. And silver is underperforming gold a little bit, and I think that's understandable because the ultimate safe haven, really, I think, is gold, and it's easier for big money to get gold than silver. Silver is very bulky still in terms of its value. The stock market is continuing to trade lower, so we need to keep an eye on that. The Dow is down another, down 200 points here, and the S&P is down 30, and the NASDAQ is down 122. And we're seeing a little bit of dollar weakness here, which might sound paradoxical with what's happening vis-a-vis Greenland, but it's the way it is, markets. So with that, I'm going to wish you all a very good day. Take care. Bye.